Hi, I'm Mark Grabowski, and I'm a lawyer and professor who wrote a book on cryptocurrencies. In this short video, I will dive into the evolving world of cryptocurrency law and what it means for American investors. Whether you're a seasoned trader or just crypto curious, this primer aims to give you insights you need to navigate the legal landscape of digital assets. Cryptocurrency was once considered the Wild West of finance, a space where innovation flourished, but regulations were scarce. That's changing fast. Governments around the world, including the United States, have ramped up efforts to regulate digital assets. But what does this mean for investors? Let's break it down. In recent years, the US government has kind of been all over the place when it comes to regulating crypto, and shifted its stance frequently, moving from a hands-off approach to imposing strict regulations to embracing crypto. 2023 marked a pivotal year with significant crackdowns on illegal activities on major players within the crypto space. One of the most notable actions was a massive $4.3 billion fine levied against Binance, which is the world's largest cryptocurrency exchange, for its role in facilitating money laundering. Meanwhile, Sam Bankman-Fried, the founder of the now collapsed FTX exchange, was criminally convicted and sentenced to 25 years in prison for orchestrating fraudulent activities that led to the collapse of his empire. But since then, the US government appears to have become more crypto-friendly. In 2024, the US Securities and Exchange Commission finally approved the first Bitcoin ETFs, giving mainstream investors a way to gain exposure to Bitcoin through the stock market. But the biggest shakeup came in 2025 when President Donald Trump returned to office and took an aggressive pro-crypto stance. So what's changed? Trump's administration has introduced policies designed to boost the digital asset industry. One of the biggest moves was a proposal to eliminate capital gains taxes on US-issued cryptocurrencies. That would make crypto more attractive, but it also raises important questions. Will this encourage more investment, or will it fuel speculation and market bubbles? And what happens when the government starts losing tax revenue from crypto traders? Another major shift is the creation of a US strategic cryptocurrency reserve, holding assets like Bitcoin, Ethereum, and Solana. It's an unprecedented move that sent crypto prices soaring, but skeptics wonder if it could destabilize markets in the long run. One of the biggest sources of confusion in crypto regulation is the jurisdiction battle between two federal agencies, the Securities and Exchange Commission, or SEC, and the Commodity Futures Trading Commission, or CFTC. The SEC regulates securities, while the CFTC oversees commodities. But where does crypto fall? Well, that depends. The SEC considers most crypto tokens to be securities, meaning they have to follow strict federal laws. Meanwhile, the CFTC treats Bitcoin and Ethereum as commodities, subjecting them to different regulations. This tug of war has left investors in a legal gray area. With the Trump administration easing SEC enforcement, some crypto companies are breathing a sigh of relief. But does that mean clearer regulations are coming? Or are we just kicking the can down the road? While the government is trying to create more crypto-friendly policies, that doesn't necessarily mean stronger protections for investors. Unlike traditional banks, crypto transactions are irreversible, and if you lose your funds due to fraud or a hack, you're often out of luck. You can't get those funds back. Privacy is another issue. A lot of people think crypto is anonymous, but in reality it's more pseudonymous, which means that while your real name isn't directly attached to your cryptocurrency transactions, your activity can still be traced back to you. Your transactions are recorded on a public blockchain, and with the right tools, authorities can trace them back to you. If you've used a regulated exchange like Coinbase, your identity is already tied to your crypto holdings. Even privacy coins like Monero and Zcash aren't foolproof. Speaking of exchanges, let's talk about where you actually trade crypto. Centralized exchanges, or CEXs, like Binance and Coinbase, make it easy to buy and sell, but require users to trust a third party with their funds. But here's something many investors don't realize. These so-called exchanges aren't regulated the same way as traditional stock exchanges, like the New York Stock Exchange or NASDAQ. While the New York Stock Exchange operates under strict SEC rules designed to protect investors, most crypto exchanges have far fewer regulatory requirements, meaning there's less oversight and fewer guarantees that your funds are safe. FTX users found this out the hard way, as many customers lost their funds due to mismanagement by the exchange. But even if an exchange manages funds responsibly, investors still face risks. Cryptocurrency exchanges are frequent targets of hacking incidents, and unlike US banks, which are FDIC insured, crypto exchanges lack government-backed reimbursement protections for stolen funds. On the other hand, decentralized exchanges, or DEXs, allow for peer-to-peer trading without intermediaries. Sounds great, right? Well, not so fast. DEXs come with their own risks, like smart contract vulnerabilities and scams. Plus, if you lose your funds on a DEX, there's no customer support to help you recover them. So which one is safer? Well, it really depends on your risk tolerance. CEXs offer convenience but require trust in the third party, while DEXs provide more control but come with higher risks. One thing that hasn't changed much is the IRS's stance on crypto taxes. In the US, cryptocurrency is considered property, meaning you owe taxes when you sell, trade, or even use it for purchases. The IRS has been cracking down on unreported crypto gains, and starting in 2025, new reporting requirements will make it even harder to hide transactions. So if you're investing in crypto, keeping good records is crucial. But it's not all bad news. Cryptocurrency losses can offset taxable gains. So if you make a profit on some transactions, but incur losses on others, you can subtract your losses from your gains and only pay tax on the net profit. Fees, commissions, and other trading costs may also be deductible as investment expenses. And in contrast to stocks, cryptocurrency isn't currently subject to the IRS wash sale rule, which prevents investors from selling a security at a loss and rebuying it within 30 days to claim a tax deduction. But there is pending legislation in Congress that could close that loophole. So what's next for crypto regulation? Will Congress pass clearer laws, or will we continue to see a patchwork of enforcement? How will the Federal Reserve react to a government-held Bitcoin reserve? And what happens if the next administration reverses Trump's crypto-friendly policies? There are still a lot of unanswered questions. For now, investors should stay informed and cautious. While crypto has come a long way from its early days as an unregulated frontier, legal uncertainty still exists. Whether you're a trader, an entrepreneur, or just a curious observer, understanding the law is key to navigating this space. Well, that's crypto law in a nutshell. Once again, I'm Professor Mark Grabowski, and thanks for watching.